Today's direct update is one that millions of older Americans have been waiting to hear. A new Internal Revenue Service payment cycle is scheduled to begin on February 5th, and it is already creating widespread attention among retirees, Social Security recipients, disability beneficiaries, and households living on fixed incomes. For many seniors, any mention of a stimulus-style payment immediately brings both hope and caution because the past several years have shown how critical these payments can be during periods of economic pressure. Rising living costs, higher prescription prices, increasing housing expenses, and everyday necessities have forced many retirees to rethink how they manage their monthly budgets. That is why this latest IRS update matters so deeply. It signals not only the arrival of new funds for eligible Americans, but also a broader effort by federal agencies to stabilize financial conditions for people who depend heavily on predictable income. The February 5th payment window is not being described as a traditional pandemic-era stimulus. Yet it carries similar characteristics in the sense that it is designed to deliver targeted financial relief. Federal officials have emphasized that these payments are connected to previously authorized credits, adjustments, and reconciliation processes that ensure qualified taxpayers receive money they were entitled to but may not have received earlier. In simple terms, this means the government is attempting to close gaps, correct missed payments, and provide funds that should already have been delivered through earlier programs or tax credits. For seniors especially, this type of correction can be extremely meaningful because even a modest deposit can help cover utilities, groceries, transportation, or medical costs without forcing difficult financial trade-offs. Understanding why these payments are beginning now requires looking at how the IRS operates behind the scenes. Each year, the agency reviews millions of tax records to verify eligibility for credits and benefits tied to income levels, filing status, dependent information, and prior payment history. Sometimes individuals qualify for money but never receive it because of processing delays, outdated banking details, filing errors, or missed claims on tax returns. When the IRS identifies these cases, it typically organizes a distribution cycle to send the funds automatically whenever possible. The February rollout reflects months of administrative review, data matching, and federal coordination intended to move money into the hands of Americans who are legally eligible. For retirees, one of the most important things to understand is that many payments connected to tax credits do not require a new application. If a person filed taxes and met the criteria tied to the credit, the IRS usually calculates the amount independently. This approach reduces paperwork and prevents older adults from navigating complicated enrollment processes. It also means that some recipients may receive funds without expecting them, which can be both a relief and a surprise. Financial experts often remind seniors to monitor their bank accounts and official mail during major payment windows so they can quickly recognize legitimate deposits and avoid confusion. Another reason this February distribution is drawing attention is the broader economic climate. Although inflation has cooled compared with previous peaks, prices remain elevated relative to what many retirees were accustomed to just a few years ago. Grocery bills continue to stretch monthly budgets. Property taxes in some regions have climbed, and insurance premiums have increased for many homeowners. Even modest cost shifts can create strain when income is fixed. Government agencies are well aware that older Americans tend to feel these pressures first and most intensely because they typically cannot offset rising expenses by re-entering the workforce or expanding their hours. This is precisely why targeted payments can act as a financial buffer. They do not permanently change a retiree's income structure, but they can provide breathing room during expensive months. February is often a particularly heavy financial period following holiday spending, winter utility costs, and annual insurance renewals. A deposit arriving at this time can help households regain balance before spring expenses begin to appear. Many financial planners describe these payments as stabilizers rather than windfalls, emphasizing that their greatest value comes from reinforcing financial security rather than encouraging sudden spending. It is also important to clarify that receiving Social Security does not automatically guarantee eligibility for every IRS-related payment. The two systems operate separately even though they often serve overlapping populations. Social Security benefits are managed through one federal structure while tax credits flow through another. However, the intersection occurs when tax records show that a Social Security recipient qualifies for a credit based on income thresholds or filing data. When that happens, the IRS processes the payment regardless of whether the individual is retired, disabled, or still working part-time. Many older adults remember the rapid stimulus distributions that occurred during national emergencies when payments were authorized quickly and delivered on a broad scale. The current situation is more methodical. Rather than universal checks, these payments are targeted toward people whose records indicate they are owed money under existing law. That distinction matters because it shapes expectations. Not every senior will receive a deposit, but those who do can be confident it stems from verified eligibility rather than temporary policy expansion. The question of qualification is naturally at the center of this update. Eligibility generally depends on income ranges, filing history, and whether certain credits were properly claimed. Individuals whose earnings fell within qualifying limits during the relevant tax year are among those most likely to receive funds. Seniors who file as single taxpayers often have different thresholds than married couples filing jointly, and these distinctions help determine payment amounts. The IRS relies heavily on documented financial data, meaning accuracy in past filings plays a major role in whether a payment is triggered. For older Americans who live primarily on retirement income, taxable earnings may appear lower than those of working households, which can sometimes increase eligibility for credits. At the same time, retirees who draw from multiple income streams such as pensions, investments, or rental properties may fall outside certain limits. This variation highlights why there is no universal outcome. Each payment reflects a unique financial profile built from the taxpayer's most recent verified information. Another factor shaping eligibility involves whether an individual already received the full value of a credit during an earlier distribution. If the IRS determines that only a partial payment was issued previously, it may send the remaining balance automatically. These adjustments are often described as reconciliation payments, meaning they reconcile what was paid with what should have been paid. Seniors who experienced life changes during the relevant tax year, such as retirement transitions, shifts in income, or household adjustments, may be more likely to see these recalculations. The delivery method for these payments is expected to mirror previous IRS distributions. Direct deposit typically arrives first because electronic transfers move faster through the banking system. Paper checks follow afterward for recipients whose banking information is not on file or could not be verified. Some Americans may also receive prepaid debit cards if that method was previously associated with their tax records. Regardless of format, the goal remains the same: to ensure funds reach eligible households safely and efficiently. Older adults are often encouraged to remain attentive but calm during major payment cycles. Financial scams tend to increase whenever government money is discussed publicly. It is crucial to remember that legitimate federal agencies do not demand fees to release payments, nor do they request sensitive information through unexpected phone calls or messages. Awareness alone can prevent unnecessary stress and protect retirement savings from fraudulent activity. Beyond the mechanics of qualification and delivery, this update reflects a broader policy mindset that has been gradually evolving. Federal agencies have increasingly prioritized accuracy and completion when it comes to benefits distribution. Rather than allowing unclaimed funds to remain undistributed, the government has shown a stronger commitment to identifying eligible recipients and ensuring payments are completed. This shift is particularly significant for seniors who sometimes miss credits simply because tax rules can be complex. Financial stability in retirement often depends on predictability. Monthly Social Security deposits provide a foundation, but unexpected expenses can still disrupt even the most carefully planned budget. When supplemental funds arrive, they can help restore a sense of control. Many retirees describe the emotional reassurance of knowing they have a cushion, even if it is temporary. That psychological comfort is an often overlooked aspect of financial support. The timing of these payments also intersects with ongoing conversations about retirement security in the United States. Policymakers continue to examine how older Americans manage rising costs while living longer than previous generations. Although one payment cannot solve systemic challenges, it can signal responsiveness to immediate needs. Each distribution represents an acknowledgement that financial resilience matters at every stage of life, including well into retirement. Some recipients may wonder whether accepting the payment could affect other benefits. In most cases, tax credit payments do not count as ongoing income for federal retirement programs. They are generally treated as one-time adjustments rather than recurring earnings. This distinction helps prevent unintended consequences for individuals who rely on structured benefit calculations. Nevertheless, many financial advisors suggest keeping records of any government deposit for personal documentation, reinforcing clarity when reviewing annual finances. The February rollout is expected to occur in phases rather than all at once. Banking systems process deposits in batches, which means arrival dates can vary slightly even among people with similar eligibility profiles. Patience becomes important during this period, as staggered timing does not indicate a problem. Instead, it reflects the logistical reality of moving large volumes of payments across a national financial network. For households that do receive funds, thoughtful planning can enhance the impact of the payment. Some retirees choose to address overdue expenses, while others strengthen emergency savings. Even allocating a portion toward future medical costs can create long-term reassurance. The most effective use is always the one that aligns with personal priorities and financial circumstances. This IRS update ultimately underscores a central principle. Benefits that are authorized under law are intended to reach the people who qualify for them. Administrative reviews may take time, but they are designed to promote fairness and completeness. For seniors who spent decades contributing to the nation's economic system, receiving money they are entitled to is not simply assistance. It is the continuation of a long-standing social contract. As February 5th approaches, awareness remains the most valuable tool for retirees and their families. Understanding what the payment represents, why it is being issued, and how eligibility is determined can replace uncertainty with confidence. Knowledge allows older adults to interpret financial developments calmly rather than react to speculation. In the larger picture, moments like this remind Americans that financial support programs are not static. They evolve, adjust, and occasionally correct themselves in response to real-world conditions. Whether the payment covers essential bills or simply provides breathing room, its presence reflects an ongoing effort to support stability for those who rely on structured income. Looking ahead, economic conversations across the country continue to focus on affordability, retirement readiness, and the long-term sustainability of support programs. While debates may shape future policy, the present distribution is rooted in existing law and administrative responsibility. Its purpose is not to create temporary excitement, but to fulfill obligations that already exist within the financial framework for families who help manage the finances of aging parents or relatives. Awareness can be especially valuable. A sudden deposit may prompt questions, and understanding its origin allows caregivers to respond with confidence. Clear communication within family strengthens financial decision and prevents unnecessary worry. Ultimately, the significance of this IRS update extends beyond the transaction itself. It reflects an ongoing effort to maintain fairness within the system, ensuring that qualified Americans receive what they are due for retirees who spent decades planning for stability. That fairness reinforces a sense of continuity between their working years and their retirement life. As February progresses and deposits continue, the clearest message remains one of preparedness and calm awareness. Monitoring accounts, keeping records organized, and approaching financial decisions thoughtfully allows each household to benefit fully from any support that arises. Whether the payment is modest or substantial, its value is measured not only in dollars, but also in the security it helps create. In closing, this update reminds every older American of something deeply important. Financial support programs are designed with the intention of reaching those who qualify. And when the system works to complete those payments, it strengthens the foundation of retirement itself. The February 5th distribution represents diligence, accountability, and recognition of the financial realities many seniors face today. By understanding how these payments are determined, why they are being issued, and how they fit into the broader retirement picture, older adults can move forward with greater confidence. Staying informed transforms uncertainty into clarity.